As you tally up what your retirement income will be or already is, don't forget to account for taxes. You see, taxes can be one of your largest expenses in retirement. And are you aware of how each of your different sources in retirement income is going to be taxed? So today we're going to discuss how the typical or primary sources of retirement income are taxed. And I know what you might be thinking, well, it is what it is. But understanding this, we've helped a lot of clients, people just like you, review and reduce their long-term tax burden. So stick around to the end because I'm going to talk about 5 strategies to help reduce taxes, strategies that you can put into place whether you're still working or whether you're already retired. I'm Scott with Sierens Financial Group, where we help people with their key questions. Are you on track for retirement? What can you do to improve your overall financial picture? Or how can you help reduce your tax situation? So based on where you've worked or where you've saved and how you've invested, you may have multiple sources of income in your retirement. That's great. But as you're starting to look at what that retirement paycheck might be, or if you're in retirement, looking at your current retirement paycheck and retirement income sources, don't forget to account for taxes. How much? Well, that all depends on the source. So focus in this video is how your primary or typical sources of income in retirement or withdrawals from different accounts that you're using for income in retirement, how those could get taxed and how they could potentially be taxed from a federal tax standpoint. Now, based on the source, it most likely will get taxed in one of 3 ways. The first way would be taxed at your ordinary income tax rate. Well, what do I mean by this? Well, if you think most of the times you hear you fell into a certain tax bracket, right? Those tax brackets go 10%, 12%, 22%, 24%. Then we've got 32%, 35%, 37%. Now, which bracket you fall in and how much income gets taxed at which of those rates all depends on how much income that you have going in. Now, one thing to consider is that first off, those are rates for 2021. Those rates are subject to change if Congress decides to meet and enact new tax rates. Also, how much that you'll get taxed at is subject to change based upon how much income that you have coming in. But realize that, again, those rates, ordinary income tax rates, are at those different brackets and could go anywhere from 10% up to 37%. The second way that you could potentially get taxed on income that you have coming in is at the capital gains rate. And I always say that this is the more favorable rate. And the reason I say that is because the capital gains rate could be either 0%, 15%, or 20%. And your income that's getting taxed at these rates, I can say it's more favorable because usually based upon, again, this is all how your taxes get filled out each and every year, but usually income that gets taxed at these rates is falling at a lower rate than where your ordinary income tax rate falls. So you could get taxed at the ordinary income tax rate, maybe some sources of income that way. Maybe some sources of income are just getting taxed at the more favorable capital gains rate. Or the third way that income could be taxed, well, actually not getting taxed at all. It could be coming to you tax-free. Well, for all of these, Congress could change the tax rates at any time. So as we go through today, what I would suggest too is go to the IRS website and look at IRS guidelines to see the current tax rates for whatever year that we are in. Now, all of this adds up. So based on where you've saved or the different sources that you have coming in, we've seen a lot of people that actually could be paying more in taxes in retirement than they are today. I know what you're thinking. Wait a second. As I retire, I no longer have my company paycheck coming in. Shouldn't my taxes be less in retirement? We'll talk about that in today's video, but in some cases, your taxes could actually be more in retirement than they are today. All right, so let's dive in to some of the typical retirement income sources and how they're taxed. Our first source, the primary source, Social Security. Now, I know what you're thinking. Wait a second, my Social Security gets taxed? Well, depending on how much you make, up to 50% or up to 85% of your Social Security can add in to your taxable income. So for those individuals making between $25,000 a year to $34,000 a year, or if you're married filing jointly and your combined income is between $32,000 and $44,000 a year, up to 50% of your Social Security benefit can add in to your taxable income and therefore get taxed at your ordinary income tax rate. Now, if you're an individual making more than $34,000 a year, or again, married filing jointly, having a combined income of more than $44,000 a year, then up to 85% of your Social Security gets added into your taxable income, and again, would get then taxed at your ordinary income tax rate. Next on the list, maybe you have a pension coming in. Pensions are primarily, most of the times, pensions are funded with pre-tax income, meaning the way it was funded, it never got taxed. Therefore, when you are receiving your pension, most of the times they are the full amount is subject to ordinary income tax rates. Maybe you have some rental property and you have some rental income coming in. Well, that rental income is also taxed at ordinary income tax rates. Now, the one thing about rental property is that you might have some expenses that you would be able to write off. So you also might be able to use that rental property for some potential deductions against other gains or income that you have on your overall taxes. Next, let's talk about withdrawals from your retirement assets. For most people, Social Security or your pension might not cover all of your lifestyle expenses. So that's why you have retirement savings as well. Let's chat about the taxation of the withdrawals, the money that you're going to take out from these different retirement accounts, again, to supplement your income in retirement, to maintain your lifestyle. And money that we save up typically goes into one of these three buckets. So the first bucket has a lot of, you might hear it called a lot of different names. It could be called the non-retirement bucket or the non-qualified bucket or the taxable bucket. But some examples that would go into this bucket or would fit in this bucket are your checking, savings, CDs, a brokerage account, or it could be stocks, bonds, mutual funds, exchange traded funds, again, all that are in non-qualified, non-retirement type accounts. Now, how are these specific accounts taxed? Well, there's actually three different parts or three different ways that you may be taxed in this bucket. First off is any interest that could be generated in this bucket. That interest that's generated, you're taxed at ordinary income tax. You're taxed at your ordinary income tax rate. If you buy or if you sell assets from this bucket, again, to generate retirement income, you could be looking at short-term gains, or you could potentially be looking at long-term gains. Those short-term gains, those are taxed at ordinary income tax rates. But the long-term gains, well, those are taxed at the more favorable capital gains rate. We'll talk about that in some strategies at the end of the workshop. Also, if you're wondering about capital gains rate and the capital gains tax, I have a video that you should take a look at called the capital gains tax to help you understand more the capital gains tax rate and some strategies around capital gains. And then the last on the list is dividends. So you might have, again, stocks, bonds, or stocks or mutual funds or exchange traded funds that are paying you dividends. Well, those dividends, based on the type, will tell you how they'll get taxed. Ordinary dividends are taxed at your ordinary income tax rate. Qualified dividends, however, those dividends are taxed at the more favorable capital gains rate. Why do I say that it's more favorable? Right now in 2021, the capital gains rate is 0%, 15%, or 20%. So in comparison to your ordinary income tax rate, that most likely is at a lower rate than where you're falling in the current tax brackets. All right, let's take a look at our next bucket, the tax deferred bucket. Some examples that fit into the tax deferred bucket could be your 401k, IRA, 403b, 457, your SEP IRA, or a simple IRA. Money that was put into this bucket, you have not paid any sort of income tax on it yet. You actually got a deduction in the year that you put money into the bucket. So as you take withdrawals from this bucket, all qualified withdrawals are going to be subject to your ordinary income tax rate. The other thing to keep in mind when it comes to this bucket and the different accounts that you might have in this bucket is this bucket is subject to required minimum distributions. That's right. So it's the bucket where you're forced to take withdrawals from. Right now in 2021, that age that you have to start taking withdrawals is age 72. That could always change in the future. But depending on how much you've saved up, these required minimum distributions could be thousands of dollars, tens of thousands of dollars, or hundreds of thousands of dollars. Now, I want you to just pause and think about that for a second. Think about taking out from this bucket $50,000, $100,000, $200,000, $300,000 or more in your retirement, and understanding that all of that adds into your taxable income. You see, the RMD withdrawal rate, the rate where you have to take those distributions out of this bucket, that rate actually goes up with age. So if you're getting gains in your accounts, again, for those that have saved up, say 500,000 or more in this type of bucket, it's something that you really need to be prepared for, that over time you could see a pretty hefty required minimum distribution coming out of this bucket. This is a reason why a lot of people will fall into a higher tax bracket in retirement than where they're at today. Okay. The last bucket that you might have money saved up in could be the tax-free bucket. And some examples of accounts that you would have money saved up in there would be a 401k or a Roth IRA. All of the money that you decide, all qualified withdrawals that you take from this bucket will come out to you tax-free. No federal taxes have to be paid. It's a bucket that sounds pretty good, right? Again, when you put money in, you pay tax on it. But the money that you have in that bucket, plus any of the gains that you have in that bucket, all of that money can be withdrawn. Again, all qualified withdrawals can be made tax-free. Okay, let's talk about some other items that might be sources of income for you in retirement. One might be an annuity. If you own an annuity, withdrawals from those annuities all depends on what type of account that annuity sits in, meaning what tax bucket does that annuity sit in. So if the annuity sits in a Roth, well, your withdrawals from that annuity would be tax-free. If that annuity sits in an IRA or 401k, then the withdrawals from that annuity would be subject to ordinary income tax. Now, if that annuity is in a non-retirement account, so that non-qualified type of account, then you would be subject to ordinary income tax on the gains that you have in the annuity. So when you're withdrawing from that annuity, you're going to be subject to ordinary income tax, not on the base, but on the gains that you take out from that annuity. And talk to your tax consultant on that one about what comes out first and second, gains versus base. But just so you understand, you will be subject to some taxes on an annuity that sit in a non-retirement account. Another item that you could be getting retirement income from would be a municipal bonds or municipal bond funds. The interest from these municipal bond funds are actually exempt from federal income tax. However, remember this, if you go and sell the bond or sell the bond fund, then you could be subject to capital gains and losses based upon the price at which you purchased it at. Another item, and boy, this is a really powerful item for retirement income, is your HSA and HSA withdrawals. Withdrawals made from an HSA for qualified medical expenses are all made tax-free. I'll talk about this in a little bit when it comes to the 5 strategies to help reduce or lower your taxable income in retirement. But HSA withdrawals, you can make those tax-free. Folks, I hope you're getting a lot of value and benefit out of this video so far. Now, before I move into the 5 strategies, if you are and you'd like to see additional videos just like this to help you build wealth and reduce your long-term tax picture, subscribe to our YouTube channel or connect with us on Facebook. That way you get notified as we continue to come out with additional videos just like this to help you in your financial future. All right, let's talk about the 5 strategies to help you reduce your long-term tax burden. And again, these are strategies that you can put into place if you're still working or if you're already retired. Now, the first one is tax diversification. What do I mean by that? Well, what I find is that there's kind of this age-old rule that we should put all of our money into that middle bucket, right? Your 401ks, your IRAs, 403bs, 457s, because it felt really good to get that tax reduction in the year that you put the money in. However, as I showed you, because of those required minimum distributions, it could actually put you in a higher tax bracket in your future than where you're at today. By putting too much money into that bucket, tax rates in your future could be higher than where they're at today because of those required minimum distributions. So tax diversification is actually saving money into the 3 different buckets. How much? Well, that all depends on your circumstances, your current income versus where you feel like your future tax rates might be. But it's a strategy to put into place to help, again, balance today's taxes, but also help try to reduce your long-term tax burden. The next strategy, using tax-efficient funds. I see a lot of times where people are using investments or funds in that first bucket, that taxable bucket, that are creating extra taxes for them each and every year. So you might want to think about using tax-efficient funds in that bucket. Now, again, all depends on your circumstance, your income. You want to talk to someone, an advisor that focuses on tax planning, not only helping you look at today, but also looking at the future. Maybe you want to use municipal bonds or municipal funds in that bucket, or maybe you want to use exchange-traded funds versus mutual funds. Exchange-traded funds seem to be a little bit more tax efficient than mutual funds are. All right, our third strategy, contribute to an HSA account. Now, not everybody has this available to them. Actually, there's a video that I have on my channel as well as our site. I'd recommend going to take a look at it, what an HSA is, if it's available to you. But if it is, this is a very powerful tool. Again, HSA is a health savings account. You may have this available to you at your current employer. If so, here's why I call it a powerful tool, because as you put money into your HSA, health savings account, you will get a tax deduction the year that you put the money in. Now, as long as you utilize that money for qualified medical expenses, that money that gets taken out can be utilized tax-free. But here's the third part that makes it pretty powerful. You can also invest this money. And so when you invest it, that growth is also tax-free. And those withdrawals of that growth, again, for qualified medical expenses, can be used tax-free. So contributing to an HSA can really help you pay for medical expenses in your retirement in a very tax-efficient manner. All right, number 4, Roth conversions. Looking at paying tax today at a known rate to get money into your tax-free bucket and then having it grow tax-free where you can make withdrawals tax-free. And my fifth strategy to share with you today is what I like to call timing. What's this mean? Well, based on the timing of when you take your Social Security, when you retire, when you might do a Roth conversion, when you make withdrawals from different buckets, putting all of that together in a strategic plan can really help you reduce your long-term tax burden. Folks, as you can see here, tax planning is really important in helping you potentially reduce your current as well as long-term tax burden. Again, keeping more of your hard-earned money with you and in your pocket versus giving it to the IRS. So understanding this, working with an advisor that has a tax planning focus can really help you keep more of your retirement paycheck in your pocket. I really hope you enjoyed this video today and found a lot of value and benefit in it. And if so, and you'd like to see additional videos like this, subscribe to our YouTube channel, connect with us on Facebook. That way you get notified as we continue to come out with additional videos just like this to help you and your financial future. Thanks, and have a great day.